Welcome back to Trading Manifest. Just in case you're visiting for the first time, I'm a day trader and make videos about how to level up your trading skills. You can click the link that appears in the top right corner of the screen to watch the introductory video of the channel. We're finally starting the technical analysis courses just as I promised. As you can see, the first video of this series is about identifying trends and incorporating them in our trading strategy. Before we jump into it, I want to make things very clear by showing you this reddish notice. We do not use trends and trend lines to enter or exit trades. Rather, we use them to get an overview of the market. So bear that in mind for the rest of this video. Otherwise, it might give you the wrong idea about our trading mechanism. Okay, let's see what topics will be covered throughout this course. Number 1, we will examine the origin of the trend theory and its applications in modern trading. 2, we will demonstrate the correct way of drawing trend lines in such a way that we don't end up losing the big picture of the market. Number 3, we'll discuss how to integrate the trend theory into our trading system most effectively. And finally, I'll review what we've covered in this course so far and build a bridge between this tutorial and future ones to ensure we're on the right track. With these topics outlined, let's begin. This handsome dude right here is Charles H. Dow. He is the mastermind behind the trend theory, although many other individuals have also contributed to its development. The theory consists of 6 main tenets or laws. I changed the order of these 6 laws and I'll tell you the reason after mentioning all of them. Number 1, market has 3 different kinds of movement. 2, a trend consists of 3 main phases. Number 3, strong trends are confirmed by their volumes. Number 4, trends tend to persist until a clear sign of reversal occurs. Number 5, all the available information has priced into the chart. And the last one, to confirm a primary trend, both DJIA and DJTA must point to the same direction. So at this point, you might be wondering how a theory over a century old can be useful in our trading system. Well, you're right to some extent, but there are some key aspects to this theory that still hold true today. Out of these 6 laws, the last 2 are outdated and are of no value to our trading strategy. They may have been significant during Dow's time, but might not be as applicable to today's fast-paced, highly technical market environment. So I'm not going to explain them and leave them for you to study. However, I give you 2 versions of Dow theory explanation to discover for yourself. The first one is the short version from the Financial Wisdom channel, and the other one is the long version from the Fractal Flow channel. The first law says that the market has 3 different kinds of movements. Let's take the Nasdaq chart as an example. It is clearly going up. The theory calls this bullish run the primary or the long-term trend, which lasts more than a year. Within this primary trend, 2 additional movements occur: secondary or short-term trends, which are always against the primary trend. They are minor corrections in the price, and every time more investors jump in and push the price to a newer high. They can last between a few weeks to a few months. And finally, there are minor fluctuations within the primary trend. They are also against the primary trend, but only last a few days to a few weeks. They are like noise in a big signal. While the Dow theory uses this term to explain long-term trends, we can also apply them to shorter time frames, such as daily or hourly charts. Doing so enables us to identify significant movements amidst the market's numerous insignificant fluctuations that occur on a daily basis. The second law states that each trend consists of 3 main phases. In an uptrend, there is an accumulation phase wherein major investors begin purchasing the asset from the small players and make the price stable for a considerable amount of time. The second one is the public participation phase. During this time, other retail investors start noticing that price has begun a bull run and buy the asset like crazy because everyone is so optimistic about it. At the end of the uptrend, there's an excess phase where naive investors who are unable to estimate the intrinsic value of the asset accurately jump in and make the price to reach one or maybe two new highs. After that comes a downtrend. It initiates with a distribution phase. Just like the accumulation phase, the major investors begin to pull out their cash out of the asset by selling the asset to the small players. After this, a second round of public participation occurs, but this time everyone is on the panic mode, and the pessimism is the prevailing sentiment of the market. This causes the price to drop significantly. After this panic, everyone hates the asset for not being profitable anymore, and there's no buyer in the market. So the price keeps fluctuating in a very small range. This is called a despair phase. However, the good thing about the despair phase is you can buy a fundamentally valuable asset with a super cheap price. That's why I emphasize on boosting your fundamental knowledge. The next law says if it is a real trend and not a fake one, we should see an increase in the trading volume of the asset. Look at this chart. As you see the price starts going up, the volume rises accordingly. Then the movement slows down and we see a decrease in the volume. After that, a strong bearish trend gets in the way and we see the volume goes up drastically. This law can help us find sweet spots to look for reversals. This law tells us trends are likely to continue their way until a clear sign of reversal is seen. For instance, we see a bull trend here. The market makes a little pullback to the trend line followed by a bearish candle, and after that the trend reverses. Therefore, the pullback and the bearish candle formation collectively serve as a potential reversal sign. This is just one combination for a reversal setup, and I will introduce more of them as we go further. With the Dow theory fully explained, let's go ahead and practice drawing trend lines on the charts. The first example is really an easy one. We see a downtrend here. So all we need to do is to look for lower highs and lower lows. Let's go for lower highs first. Find them one by one and then draw the line which has the most amount of touch points with the lower highs. Usually 3 touch points or more is considered a good number. Now do the same for the lower lows and draw the best line you can. Perfect. You did a good job. On to the next example. This one is trickier. We have the end of a downtrend and then the emerge of an uptrend. Let's figure out the downtrend first. We have 2 highs and 3 lows. It was simple. But how about the uptrend? Should we count the tip of this long shadow as one of our lows? Well, it is a key point in our chart, but I prefer to count this as a stop hunt and further elaborate on it in my supports and resistances course. So for now, since it has no effect on the reversal of the chart, we are going to ignore it. And these are our lows and highs for the uptrend. As you can see, trend lines cannot always indicate the market's behavior in a perfect way. That's why we have multiple factors to trigger a trade. The third example is fairly straightforward. We can identify a clear trend line here. They are more like support and resistance levels. That's another instance where trend lines can't help us to decide what to do next. I hope you get what I'm trying to do. None of the technical analysis tools we use are magical. They all have their advantages and drawbacks. It is up to us to be wise and pick the one that suits best for us. Alright, example 4. What do we got here? One shadow to the upside here, and one tiny shadow to the downside here. Okay, now let's find out the key lows and highs. This had been our key lows and highs, but before they were haunted by the 2 shadows I just mentioned. As a result, they can no longer help us to find our desired trend line. So we remove them and find other lows and highs. As you can see, we are able to draw our trend lines. But in this case, I prefer not to use them for 2 reasons. 1, the touch points are not accurate, and 2, the 2 lines are converging, indicating that the price compression is occurring, possibly leading to a range formation. Example 5 is on the crude oil chart. It looks like a smooth downtrend, but what do we do with these lows and highs so close to each other? Well, the strategy is simple. Just pick the lows that are lower and the highs that are higher, for both uptrends and downtrends. If we apply this rule to our chart, we get this. And the last example is on the gold chart. But I'll leave this example for you to solve. Just use the techniques I told you in the previous examples and get rid of the shadows and close lows or close highs to obtain the answer. Okay, we have reached the most important part of the course, and that is how we implement trend lines in our strategy. Before I reveal my strategy, I want you to like the video and subscribe to the channel, as it motivates me to put more effort in making high quality courses like this. I really appreciate it. Our strategy uses trend lines for two scenarios. One is to see whether a market trend matches our fundamental information, and two is to find possible traps for stop hunting. Obviously, I'll explain each of them with examples, so don't worry. This one is about gold again. On September 18, 2024, the Federal Reserve was about to announce the interest rate for the US banking system. Nearly all the expectations had been set on 0.5% rate cut, from 5.5% to 5%. This had come from the previous Fed sessions where he indirectly signaled the rate cut in the September session. As you might know, rate cuts weaken the US dollar power against the other assets like gold, and therefore we should have looked for buy positions if the news was announced as we expected. The news was announced as we wished on this candle, and then the chart rallies towards a new all-time high for the gold price. This is why we should always check if the fundamentals match our primary trend. I personally love this second example because it clearly indicates how big players manipulate the market for their own good. As we all know, Russia invaded Ukraine on February 24, 2022. So our fundamental knowledge tells us that in high-risk conditions like this, gold acts as a safe haven for investors, and thus gold's price must go up like a rocket. But look closely what happened. This is the war candle. Market went up for a few hours, but then suddenly reversed direction and dropped about $100 in a single day. And guess what? The daily candle closed in red and took all the stop losses below the blue support line. Can you believe it? On the day of a war? But then look what happened in the next days. The price got a powerful bullish momentum and broke its all-time high to reach almost $2,070. The second application of trend lines for me is to identify potential stop hunting traps. For instance, we draw a trend line like this, and we know when the price moves above this high and hits our trend line, it can be a possible stop hunt and a reversal in the primary trend as well, just as we see in this example. Another example on Euro USD. First, we draw our trend line. The price breaks above our recent high, hits our trend line, and the market primary trend reverses. Okay, let's wrap up what we learned in this course. We studied the trend theory and examined its laws. While we discovered that two of these laws may be outdated, the remaining laws can still prove useful in most situations. Afterward, we figured out how to draw trend lines accurately. We also came across a few examples that indicated drawing trend lines isn't always the best choice. Then, we learned how to incorporate trend lines into our trading system and witness how effective they could be if used in the right place. The next course will be all about supports and resistances. So subscribe and hit the bell to be notified as soon as it is published. That's it for this video, guys. Thanks for watching, and I'll see you in the next video.